Hi there, welcome back to You Heard It from a CFP. My name is Matthew Coyle, with you as always, episode 53 of You Heard It from a CFP. It is post-Labor Day, it is time to get back to work, the kids are back in school, I'm fired up. Let's talk about the market, let's talk about the Fed, let's talk about rates, let's talk about what to do with your money right now, let's dive in. Okay, it is no secret that the last 12 to 18 months have been very challenging for investors. I've done plenty of videos on this, the topic has been explored. We know it, and one reason is because of the chart I have in front of me right here, which is the repricing of money around the world, which is really what's going on and really what's driving the market activity that we've seen the past 12 to 18 months. Very simple. The cost of money is going up. The cost of money is being repriced. And you can make the argument it was far too cheap for far too long, and now the market is trying to recover most of that, or a good chunk of that, in a very, very short time frame, which is causing a lot of market volatility. S&P worst first half of the year since 1974, NASDAQ worst half since 1985, 60-40 portfolio worst ever start to the bond market. And again, it's just simply because everything around the world is being repriced because the cost of money is being repriced. Very simple, and it's being driven by the federal funds rate primarily and the Federal Reserve. So this chart first here is the federal funds chart from roughly mid-2015 until now. What I'll do is I'll show you a few more to talk about where money is flowing right now, or where you might be, or where you should maybe be considering putting money, and what the market is doing now, and why it might be actually a fairly good time to invest based on history. So let's take a look at this first chart. So the first chart is just this federal funds chart from 2015 till now, and that's basically showing you the cost of money going up, the federal funds rate. The Fed is raising rates to fight inflation. We all know what's going on there. We'll look at the next one here, and this is the effective funds rate going back to 1987. So if you look at the Fed funds rate, and we're going to look at 5 periods where the Fed was raising rates and what happened during those times and how you should have been invested back then and how you might want to be invested now. So let's take a look at this chart here. We have 5 periods, 88 to 89, 94 to 95, 99 to 2000, 04 to 06, and 15 to 18 as those 5 periods where the Fed pretty methodically raised rates, only to lower them again, and the Fed is doing the same exact thing now. And the question is, how should you have been invested during those times, and what should you be considering doing now? Let's look at the next chart. Let's look at how some commonly held assets did during those 5 periods of rising rates. So you had those 5 periods I just described, okay, 88, 89, 94, 95, 99, 2000, 04, 06, and 15 to 18. Those 5 periods of rising rates when the Fed fairly aggressively and methodically lifted their target rate, their Fed funds rate target, and how those various assets did. Now I'm looking at the bottom of the screen, okay, the bottom of this chart. If you look at the average return across all those asset classes, and that's the 2-year treasuries, 10-year treasury, the aggregate, which is basically a big bond aggregate fund, short corporate bonds, asset-backed loans, which are what bank loans are, high yield, and then growth and value stocks. The average investor did fairly well in the stock market during periods of rising rates. And we typically see this during periods of rising rates. Stocks, particularly anything that pays a dividend or any growth, they typically do fairly well during periods of rising rates. Okay? So it's a very interesting chart. Bonds typically don't do as well. They don't do typically as bad as they've been doing. Okay? They don't do that poorly most of the time, but they do not typically see a lot of appreciation in value. Still get your coupons, still get your income, but they don't typically rise in value much during interest rate periods. That is reserved primarily for real estate and for stocks. So let's move on to the next chart, okay? And we'll look at where we stand now as far as growth stocks and the S&P 500. Okay. S&P 500. Now the reason I'm using the S&P 500, it is a widely quoted index. It's not the only large cap growth index. You could use the NASDAQ 100. You could use the Dow if you really wanted to. You could use the Wilshire 5000. I'm just using the S&P 500 simply because it's a well-known index and it's a fairly good proxy for large cap growth. And of course, it's fairly easy to buy. You can find an S&P 500 index fund pretty much anywhere for almost no money. So let's look at this. So where do we stand today on a forward earnings multiple? What do I mean by that? What I mean by that is, as investors, we are willing to assign a growth multiple to a share of stock or an index whenever we make our purchases. And that growth multiple is a multiple in the amount of earnings that index or that company is planning to make or projected to make Historically, the average is about 15, 16 for the S&P since 97, and that's exactly where we are right now. We're about 16 and a half, 16.4 maybe at the time. This was as of August 31st of this year, courtesy, of course, of JP Morgan Asset Management. They have their JP Morgan Asset Management Guide to the Markets, which is a fairly interesting read. It comes out for public distribution widely, I think quarterly, if I'm not mistaken, but I could be wrong on that. But anyway, JP Morgan Asset Management Guide to the Markets says we are roughly about 16 times forward earnings, which is about historical average since the late 90s. So is the market crazy expensive here for large cap stocks? Not historically, no, if you believe the earnings estimates. It's certainly not cheap. I did a video not too long ago about small cap and mid cap versus large cap. If you're going to put money in the market right now, the small and the mid caps are certainly much cheaper than the large caps relative to earnings. They've taken the brunt of the beating this last cycle. So with regard to large cap, we are right about average where we typically are during the cycle, and which is very, very interesting. Which leads me to my next chart, which is investor confidence, which is very interesting. Let's take a look at that next. Okay, next up is consumer confidence and the stock market. Now, I always find these charts very interesting because remember who's being surveyed in these charts. This is not the institutional crowd. This is the retail crowd that's being surveyed, and it's very difficult sometimes on the behavioral side of finance to get people to invest when times are a little more uncertain. But historically, that is typically the best time to do it. Now, in this particular chart, what you are seeing is the Consumer Sentiment Index and the subsequent 12-month return in large cap stocks as represented by the S&P 500. So if you look at the lowest points in consumer stock market confidence, they tend to coincide with the best times to invest. And we are at that point again right now. So very interesting that if you are a long-term investor, and I define that as someone who with at least 5 years in the market, because you certainly don't want to put money in the market if you need that money in less than 3 years. I tell this to everybody all the time, and I'll say it again. If you have a hard stop purchase, home purchase, big something coming up less than 3 years, that money has no business being in the market. Keep it out of the market, put it in something relatively low risk, or maybe even a time deposit cash, whatever it is, get it out of the market. If it's over 5 years, and you need to put money to work, now historically, based on historical, if you believe the trends we always see, then it typically is a pretty good time to put money in the market. So I always find these very interesting. We're at a fairly historically low confidence level in the stock market right now, which, again, if you believe the trend long term, usually a great time to invest. So let's look at the next one. Okay, next chart. Time, diversification, and volatility of returns. I love this chart because it just reinforces the long-term mindset that we always try and get our clients to adopt. Again, we're going back to the asset guide to the markets here. If you are an investor with a 1-year time frame, good luck in predicting what your returns will be. I don't know what your returns will be. Anything in a year, it's, all bets are off short term. Why do I always say 5 years? Why? I get that question sometimes. Why do I tell people 5 years on equity exposure? Well, the majority of your returns over 5 years on a rolling 5-year period in the market are positive, the vast majority. And when you go out to 10, 20, or even 30 year, for example, there's never been a rolling 20-year period in the market post 1920 that has been negative in the S&P 500. So if you have over 5 years to spare with that money, if you can keep the money in there for at least 5 years, especially during times of low consumer confidence, and say average valuations, and I've done videos on this before about where money might be best placed at this point, you're probably better off going into small and mid caps than you are in large caps right now, but you can still buy. But if you have at least 5 years, history is on your side. It is well documented. Let's go to the next chart and we'll talk about the next one. Okay, 2 more charts and then I will be done. So I just told you what I think you should be doing, which is this is a great time to invest. You should be looking at stocks, looking at investments, especially if you have over 5 years. What are investors doing and what have they been doing the last 3 months as confidence has declined? Well, they're doing what they unfortunately historically often do. Cue up my next chart. Biggest portfolio shifts as observed by Morningstar the last 3 months, out of foreign large blend, out of intermediate core plus bond, and into primarily cash and intermediate core bond. Now, there's nothing wrong with owning bonds if you're a little bit older, okay? But if you're an investor and you're moving out of certain areas and into cash and bond at a time when rates are rising, historically not a great place to be. If you have at least 5 years, again, get that money into the market, get it working. You don't have to buy a large cap if you don't want to. You can buy smaller mids, or even maybe some large value, which Morningstar is seeing some of that. A shift in large value is certainly welcome. It's been ignored for a long time. However, investors are doing what they historically almost always do, which is run from the market at maybe the wrong time. I think it's time to be looking at making some investments again, but that's just me. Final chart here, cash account returns. Why do you not want to go to cash when the market gets a little bit tougher? Because cash will not get you where you want to go. Of course, this is the, you can tell by the chart here, title, average annualized return on a 6-month CD versus inflation. The chart kind of speaks volumes for itself. I don't think I have to walk you through that. Cash will just simply not get you where you want to go. It just doesn't cover the cost of CPI inflation or education or healthcare, anything. It just doesn't cover what you need. The market is your best chance for that in the long term. And historically, if you believe the trends, now's a great time to do it with extra money if you have the time to do it, or continue to make those investments through your company plan, which of course is a great option as well. So I'm going to leave it at that for now. Thank you again for spending your time with me. It is your most valuable asset, as I always say. Take care of yourself, take care of each other, take care of your family. I will see you next time with a completely different topic. Thanks. Bye.